lot of people think that non-custodial or, wherever on the spectrum closer to non-custodial we can get, people think that like it's like a trade-off curve where like the more non-custodial you get, the shittier the product gets. And I think we've proven, and we'll continue to prove that that's not the case, that you can build a great product for users while still giving them control.
Welcome back, everybody, to the Built on Bitcoin pod. I have a fantastic episode with two Chad founders from Lygos. So let's just jump in real quick. Let's do brief intros. Let's start with you, Matt. Welcome to the pod. How you doing, man?
I'm doing great. It's great to be back. I remember being here 2 years ago, and yeah, I guess a quick intro from me. Got into Bitcoin back in 2013, 2014, and 2017 is where I really went down the rabbit hole. Just started building on Bitcoin, and I mean, I think that's where that's where it's at is building great financial tools for Bitcoin. That's what we need more of.
Huge. And you actually, as you said that, I remember you're the one that when you were in high school and like your dad got you hacking into Bitcoin, right?
That's right. That's right. My dad introduced me to Bitcoin literally back in 2013. I was in high school at the time, and he was a bit of a gold bug. So he loved gold. I remember, and even at my house, like in the couch, I would find these little like silver coins all over the place. So he was just looking for another way to store his wealth, and Bitcoin was the way to go. Went to Waterloo after that. Waterloo was actually a huge like Ethereum ecosystem. That's where Vitalik went to school, and ended up joining a team after that was doing atomic swaps between Bitcoin and Ethereum. So every day, at work, I would hear the arguments for Bitcoin, would hear the arguments for Ethereum, and I ended up on the Bitcoin side. So now I'm here.
Huge, huge. All right. And then first time caller, Jay, welcome to the pod, man.
Thank you. Thank you. Great to be on. I guess didn't get in as early as Matt. Got into Bitcoin 2017, 2018, right around, when I was in college. Did the traditional finance banking route and realized that I was on the wrong side of things. And then 22, I, moved over, joined Anchorage, which is a federally regulated custodian, helped build the lending business there, and then eventually build things like tri-party and collateral management. Saw a bunch of the CeFi blowups happen. I actually quit my job and moved over like the day after Terra Luna. So it was kind of like right into the bear market. But I don't know. We have a running joke amongst us that like, it's better to build in bear markets. Bear markets really like bring out the people who are going to be around for the long term. But yeah, joined Matt, Tony, and Francis, and have been working on Lygos since earlier this year.
Huge, huge. There's something about bear markets where it's like it's super high signal, it's quieter, so you don't get all the bullshit on the timeline. It's kind of refreshing, even though price action is gonna be terrible.
Yeah,
100%. Like I feel like when it's the bear market, you're always sitting there and there's a bunch of builders around. There's people that are building cool protocols on Bitcoin. Nobody even asks about the price. That's all the signal you need.
yeah.
Yep.
It's kind of counterintuitive when we're at like, I remember post FTX, we were at like 20K for a while, somewhere around there. And no one at 20K, no one's asking when are we going to be at 30K. But for some reason, when we're at like 110,000, people are like, oh, we're in a bear market because we're at like 104. And I'm like, you guys, like, clearly the memory's short or people haven't been around for long enough. It is what it is.
Yeah, I remember when we hit 16K and you're like, damn, this might go to zero. Like this is only gonna go down forever, and then it doesn't, obviously. Crazy times. All right, then let's jump in. There's a ton to talk about. I mean, you guys are building a very interesting DLC-based lending protocol, but you've also been building on DLCs for a long time, which we should definitely touch on. There's obviously, let's just pull the rabbit out of the hat. Lava's been in the news lately. I had Shazan on recently. You guys have a very different model. So there's a ton to talk about. I think a good place to start, though, is Atomic Finance and then lead into Lygos. Because you're using the same tech, DLCs, to build an interesting finance product. And Atomic was to earn yield, and then Lygos is to put your BTC into a loan and put it to work. So give us some of the background of Atomic Finance, and then we can go.
I think it's even more interesting to go slightly further back than that. Before Atomic Finance was called Atomic Finance, it was called Atomic Loans because we were doing Bitcoin-backed loans between Bitcoin and Ethereum back in the day. And I think we were so early for our time. This was back in like 2019, 2020, and no one was even thinking of Bitcoin-backed loans. And we ended up pivoting to allowing for folks to be able to access access to options contracts and yield on their Bitcoin using DLCs. So from that, like, we spent, I guess, at Atomic Finance, we spent several years going out and actually just building the DLC stack, right? When we joined it, there was all these folks out in the ecosystem that were trying to put, a specification together. How can we do smart contracts on Bitcoin in the most trust minimized way possible? And we basically took that tech, we ran with it, we built option strategies on top of it, and we allowed for folks to be able to access covered calls and, earn a return on their Bitcoin that way. And I know that's what we chatted about, like, I think, just over 2 years ago, Jacob. And so following that, we went and we took that and we built it and we grew it and we scaled it as much as we could at the time. But I think one of the things that we realized in the process is that, DLCs are an incredible technology for being able to lock your Bitcoin in a contract such that you know exactly what the outcomes are going to be. But it is not the greatest contract or the greatest architecture for capital efficiency, right? So if you're doing a bet between two different parties, right, you can't do multi-party. You can't easily transfer it without one of the parties being online. There's some restrictions to it, even though it is so great in terms of its trust minimization and the transparency of it and how simple it is, really. We scaled. I think we had at one point we had like, just over 200 Bitcoin locked in TVL. We had like over $100 million in cumulative notional volume at Atomic, but we just weren't able to scale it. And we were having discussions with our market maker, like, how can we scale this thing? It was just a really hard thing, just due to the way that DLCs are constructed. And so at the time, one of Jay's colleagues, Francis, and one of the guys that I had known for, I met him at a BitDevs, New York BitDevs, 5 years ago. That's where all the signal is. And he reached out to me and he said, "Hey, like, can I I love DLCs. Can I license your software?" And I was like, "Well, I don't know about licensing the software, but maybe we should work together on this." He sold me on Bitcoin-backed loans. He sold me on the same idea I had 5 years ago. How can I say no to that? And here we are today with Lygos. So we took the same tech, the same tech that we built up over 5 years, and we brought it over to allow for Bitcoin-backed loans to be used, using the exact same tried and tested setup. Yeah.
Interesting. So the you being early definitely resonates because the hot topics right now, lending is one. Like, people are finally coming around to the idea that Bitcoin is the best collateral ever, and you should put your bitch to work and not just hodl it, into infinity and die with that shit. But then there's also been a very big narrative around yield-bearing assets now. We saw it with Babylon to start, and there's like 6 billion in Babylon earning some small amount of baby token. Like, Botanics has one, Stacks has one. Like, these yield-bearing assets have been a hot topic now. So I was curious, like, I thought the biggest friction point was just maybe there was a lot of friction for the use case. Send a transaction, it does a bunch of stuff, and then you're getting, 8 or 10 or 15% yield. But it sounds like it's more that it's hard to get the lender agreements and the back-end capital side to work with this kind of model, or is it something else?
No, it doesn't have. So it actually works perfectly for loans. It was very challenging to use DLCs for options contracts because you have, if you're a market maker and you're on an exchange, you always have to deal with, how do I hedge, right? And you always want to be market neutral and you don't want to get liquidated. And so in a DLC model, each contract is individual by itself. Like, optimally, what you have is portfolio margin. You're able to have margin on the basis of all your contracts. And that's just not easy to do with DLCs, but it's actually the perfect model for loans because, the borrower is able to go and lock their collateral into a DLC. They're able to pre-sign for, the possible outcomes. Once it's locked there, you don't need to do anything with it. You don't need to move it. You don't need to re-hedge. You don't need to re-update. The only possible scenarios are in the case that you repay the loan. in which case your Bitcoin comes back to you, or you default, or the price falls substantially such that you get liquidated. Those are the only three outcomes for this type of DLC, which is why I think DLCs are actually perfect for loans.
Okay, that makes sense. And
Yeah,
then
and I guess for just
go ahead.
on the point about like, how we got here from Atomic, I guess my background, Francis and I helped build a lending book, and then obviously he met up with Matt at OpNext, and I think it was like a immediate kind of like light bulb moment where we all understood the value, because I had been building kind of like tri-party lending for big institutions where like no one trusts each other. I want to post my collateral. I don't want my lender to run away with the collateral, so we'll all find some centralized intermediary to hold it for us. And that works if both of you guys have an account at the same bank, and it's you trust the same bank, and there's a bunch of hoops and hurdles there. But it was kind of weird that like BlockFi, Celsius, all of this happened, and 2 years later, the best option for borrowing against your Bitcoin, assuming that you don't want to wrap it and put it on Ethereum or something else, was still just to hand it over. Like there was no great non-custodial option that had emerged, and DLCs seemed like the perfect tech. The first time Matt told me about him, I was like, why is this not more well understood? But obviously there's few people who understand it really well and have building on it for a long time. So yeah.
Interesting. It makes me think, I remember talking to Killian from Bolts, and he had this very interesting point around non-custodial as the future because the UX will be better. And at the time, this was like a year and a half ago maybe, and I was like, that sounds, how could it be better than Coinbase, bro? Like that sounds crazy. But his point was, as regulation comes in more and more and more, and you have to KYC all the time, that's going to be a point where it's like, or you could just scan something and send a transaction and the rest is abstracted away. And that's kind of what it sounds like you're talking about, Jay, which is that there's something fundamentally wrong with having to do it custodially, where certain things break, where if you're on an open protocol and you can make it work, you get these massive benefits. Do I have that right?
Yeah, for sure. I think and there's a broader discussion, and I'm sure Matt has a bunch of input on like the UX trade-offs, and obviously DLCs aren't perfect. There's obviously some things that are easier to do when the other party just has the funds, right? Like if my Bitcoin was just in a database at a bank, then, obviously they could make a great product around it. But I think when people think about custodial and non-custodial, it's not just the FTX situation that you're worried about. Like worst case, the lender is going and gambling with your Bitcoin, and that's awful. But there's a bunch of other these edge cases where it's like, okay, now me and the lender have to both be okay with the same regulator and regulatory jurisdiction. Like, what if I'm a borrower in, I don't know, the Middle East? Do I want the SEC or someone in the US to be able to tell my lender what to do with my collateral? Probably not. So I think over time, I do think that it gets to a better UX just because everyone's got a different set of rules. Everyone's got a different set of like trust assumptions that they care about. Everyone's got a different way they like to custody and what they believe in. And like, when you go custodial, you basically have to assume that I, as the borrower, and the lender all agree to the same stuff. The same regulatory jurisdiction, the same legal framework, all of these different things. And at the end of the day, like even if the lenders don't have bad intentions, you as a borrower can face bad outcomes. The one example I like to give is basically like prior to Celsius, BlockFi, FTX, there were a lot of crypto exchanges, Gemini and a few others who were well-meaning that got huge fines from the SEC, NYDFS, California regulators. And, they're backed by billionaires and they have a lot of money, so they were able to pay them without having to worry. But like, you can imagine like if you're lending against Bitcoin and all of a sudden, regulatory tides change and you get a $50 million fine, and they're like, oh, and by the way, that Bitcoin collateral that you guys have for your customers, that's actually on your balance sheet, so you're not allowed to send it back to them. Like there's, all these edge cases that borrowers really shouldn't have to think about. So from like a UX perspective, I think the biggest unlock is basically like borrowers get to choose what they care about and they don't have to underwrite everything else. But I agree with you. There is a lot of these like hoops and hurdles, that over time it'd be great to get rid of them, and it'd just be simple as like, sign a few transactions and you're done. You don't have to, do the whole onboarding KYC rigmarole.
Yeah. And when I was just going to add on to that, I feel like one of the things for non-custodial is also that, over time people get more, it's a combination of people get more educated, but also over time, more and more of the custodial solutions fall off and end up having problems or going under. And so at the end of the at time, you kind of have this cohesion where non-custodial becomes the long-term inevitable solution, right? So it's just a question of time where the UX of this will be better.
Interesting. Yeah, I've never heard that before, Jay, because everyone I've talked to, or at least on the timeline, is like all these centralized lenders blew up because of malfeasance. Like they were doing dumb shit on the back end. And you're,
I'm not trying to say they're
I,
not. Yeah. Like a lot
no,
of
no,
them
yeah,
were doing
I'm,
dumb
yeah,
shit.
yeah. I'm not giving them a pass. There's definitely some bad actors, but there's like an underlying thing too of like there's something inherent in the nature of the beast that's also the incentives make it messy.
Yeah, exactly. I think I'm definitely not one of these like SPF truthers or whatever you call them, the people trying to get them apart. But like I will say, like I think there were a lot of bad actors and people that did the wrong thing, but I don't think that all of them started off with the intention that like, oh, I'm going to screw over my users, right? It's that the market gets really competitive, everyone else is paying more yield or lower rates, or and then you're like, oh, well, we can give our better users a little bit better yield if we take some of the collateral and go put it on an exchange and get a margin loan, or these little like small quote unquote improvements that you can make to get your users a better product, but like you don't realize that you're compromising on security and trust. So yeah, I'm definitely not trying to like make the case that like the folks at BlockFi and Genesis did was good or even okay, but it's more just like it's like power corrupts, like if you can do it, someone will do it eventually, and you'll face the consequences.
Makes sense. Makes sense. Better to trust in well audited and working code that can handle it for you. So through that, then let's give us a high level of Lygos, and either of you can take it. But what is the product? Who is it for? What does it do?
Yeah. So the product is actually quite simple. We're basically building Bitcoin collateralized loans primarily for high net worth individuals, institutions, businesses. I think over time we'll definitely try to scale down in terms of size. Folks who really value sovereignty, self-custody, and a trust minimized way to get liquidity against their Bitcoin. The important factors for us, and someone who used to run a lending desk that had other assets, that I realized over time is basically like Bitcoiners are in it for the long term. Most people that we talk to, most of our clients are looking to borrow for project finance, building real estate projects, funding their businesses, paying for tuition or funding their lifestyle, things that are in the real world and very like sustainable and long term. What I noticed in the rest of crypto is basically like, people who are borrowing against their Ethereum or Solana are generally looking to go gamble it on an exchange or, do some DeFi trading, which, to each their own, but we don't see that as like as robust and sustainable use case. The nice part about Bitcoin is it's kind of like, um, people aren't looking for insane amounts of leverage and they really do value security. Like I do think that like Bitcoin has these kind of like two sides to it. One is the price and the commercial side. Like, I, as much as everyone else, want to see Bitcoin go to 1 million. And I think it will one day. But there's the ideological side, which is just as important for a lot of Bitcoiners, which is like, the fact that I can hold my keys, the fact that it's a bearer asset, there's proof of work backing it, all of those things. And that matters for a lot of people, where, in other assets, it doesn't. They just see it as like an investment that has a return. So yeah, right now our product is basically building, Bitcoin-backed loans non-custodially for these individuals and, doing so in a competitive way. Like what you said is like, we don't want a compromise where like, hey, come here, take out a loan. It's not going to be as great, but it's non-custodial. We want to build something where, the rates are just as competitive. And over time, we offer even more features. I'm sure Matt can get into it, but things like integrations with wallet providers and things of that sort.
Got it. And can you give us you said high net worth individual. What's the ballpark for who classifies for high net worth in this case?
So we're not actually doing maybe that's a misnomer. We're not doing an underwrite of like the borrower's ability to pay, but generally the loan sizes that we're looking to do on the platform at this point are $50,000 plus. So generally, $100,000 of collateral if you want to do a 50 LTV loan, something in that range. I think over time, we'll be able to bring it down, but obviously, we want to focus on a good experience for borrowers and giving them like kind of that white glove service. Eventually, when, it makes sense with the UX, we can scale down from there.
Okay. And on the UX question, is this an app? Is this an extension? How is the stablecoin coming to play? Like, if they use this, what does this feel like to them?
Yeah, so anyone that was familiar with the Atomic Finance app before, it is a app on your phone. You can go and you can lock your Bitcoin as collateral there, and really you can receive the loan wherever you want. We do USDC today. In the long term, though, we are working on more integrations to allow for folks to be able to not only use their phone and their as a hot wallet, but to allow for things like hardware wallets to be able to be used with DLCs, really for the first time, which is really exciting, to be able to lock their Bitcoin as collateral in an even more safe manner. So integrations with hardware wallets and, down the line, even custodians as well. So that's kind of our long-term plans.
Okay, love it. And yeah, I mean, the big benefit to loans that everyone kind of is aware of is you get the tax benefits, which is there is no tax credit to loan, and you still get the price appreciation because you're exposed to BTC. Love all that, but you get that with CeFi as well. So the other one that's kind of hanging here is the sovereignty piece, which is it's on chain. This is a DLC. So let's unpack that a little bit. And well, I guess real quick, how much do you guys go into that aspect? Meaning, like, does the average user know that they're doing this stuff and like have to know about DLCs, or do you make it pretty abstracted away in that?
I don't think they need to know much about the underlying cryptography or how DLCs work, but we do place an emphasis on them understanding the fact that it's non-custodial. So, we'd love to walk you through a demo one day here soon. But, even when you're entering the loan, we make it very clear that the collateral is being locked on chain, and these are the only circumstances it can move. Price breaches a certain threshold, or you repay the loan, or the lender fails to fund the loan. We feel like, clearly communicating what users are signing and making sure that we have user intent is very important. Obviously, they don't need to know the underlying complexities of exactly how DLCs work, but we're more than happy to share that with them. But it is very, we do try to make it as transparent as possible without having any added complexity. They're not constructing individual transactions themselves, but they can verify exactly what they're signing.
Yep.
Yeah, and,
Got
and
it.
I think
Okay.
DLCs are really a tool that makes it really easy to do that, right? Like when you're entering these things, you've only got a couple off-chain transactions that you need to go and verify like exactly where the Bitcoin is going. And so obviously we verify that inside of the Lygos wallet to be able to know exactly where that Bitcoin's going. But we're eventually going to allow for folks to export those messages and be able to go and verify that themselves. Or say if they're signing on a hardware wallet, like a foundation device, they'll be able to see like, oh, here are the exact like 3 or 4 scenarios for the DLC and exactly where my Bitcoin will go in these scenarios. And I can verify this on my device, just like I do on any hardware wallet. And then I can go and enter that DLC. Yeah.
And so it sounds like the current flow is you download the wallet. It's an iPhone iOS app, just like Atomic.
Correct.
And then you get a receive address. You send your BTC to that, and then you'll initiate the loan flow.
Yep.
Okay, and then the the stablecoin side is USDC. Do they pick the destination address, so they'll have to have a separate wallet that's like Phantom or whatever to get the stablecoin?
Yeah, right now they pick their destination address. So, you could choose whatever you want to receive the USDC. I think for us on the stablecoin side of things, and, we're going to try to make improvements for this long term, is essentially what we want to do is 3 things. One is make sure that it's on a secure and performant chain. Like the worst thing would be us sending stablecoins and then it's some random chain that goes down. The second is basically that it needs to be transparent so that independent oracles can see that the loan has been funded or repayments have been made. And then the third thing is really, most of the borrowers are looking to spend these dollars in the real world, with the exception of folks maybe taking out loans in the form of USDT. So making sure that folks can easily on and off ramp. And so from that perspective, it's not that like we think USDC or Ethereum is like superior to other things. It's a starting point, but I think it's really, over time, it's like, what can we offer so that folks can easily and securely take out the loans and use them however they want on a chain they trust.
Yep, makes sense. Okay, so let's get nerdy for half a second, because my audience digs some of that stuff, but also the sovereignty piece. People want to peek behind the curtain and understand why it works, and you guys have done some interesting stuff on the Oracle side, I understand. So you can tell me if I'm wrong, but DLCs they look like a 2 of 2 on chain, but they're a 2 of 3 technically, with an Oracle as one of the signers. And historically that's been seen as a massive custodial risk because the oracle is often by the same company. So like if they want to manipulate it, etc. So give us some color on DLC construction, but like mainly this oracle piece and what you guys are doing with it.
Yeah, so I think like one of the things, people always ask is like, why not just a 2 of 3, right? Like, why don't you just lock your Bitcoin in a 2 of 3? You have a borrower, you have a lender, and you have an arbiter. And I think the biggest unlock there really is that you can codify exactly what the possible outcomes are going to be ahead of time, right? So you're not relying on, oh, at the time of this event occurring, what is the arbiter going to attest to, or what is the arbiter going to sign for? And so for us, we're able to go and codify those things ahead of time. The other thing for us is we use a completely separate oracle. So Magnolia is our oracle. They're registered MSB, completely separate for us. They've built up their stack alongside us as we've built up our stack. And so there's that complete separation between the two parties. But I think one of the really interesting things too with DLCs in the long term is that the oracle can be blinded and not even need to know about the existence of the DLCs and the loan contracts that are being created associated with them. But it also becomes very easy to add additional oracles in the future as well that also don't need to know about each other. If you compare this to, say, like a 3 of 5, right, you can have a borrower, a lender, and 3 arbiters, but each of them need to communicate with each other in order to deal with some type of PSBT. In this case, you can have, one oracle that is simply, reviewing, the price feeds, another oracle that is looking at, the Ethereum blockchain and addresses that are being funded over there. And they can be completely separate from each other. And you can go and you can take those and put them into one DLC contract. So the ability to be able to scale this in the long term becomes, it's just so much easier with DLCs than it is with, say, a 2 of 3 multisig or a 3 of 5 multisig system. Yeah.
Interesting. Yeah, it makes me think, I mean, the term trust gets thrown around all over the place in Bitcoin. And it's like when you mention arbiter, it's like that's reputational trust. Like if they have a brand, they don't want to nuke their brand, and so they have incentive to not mess up, but you're trusting the brand, really, its reputation. Versus in code, it's as long as the computer does the thing that it's supposed to, then everything is good. Which is there's kind how do I put this? Like one of the questions I've seen pop up in the rollup community is that rollups are supposed to be mostly trustless, but they all have security councils because they don't trust the code enough yet to secure like $1 trillion, obviously. Like it's smart to have that right now, but hopefully over time, as these become more battle tested, we're good. So like speak to that a little bit because I people it's in the weeds, but like DLCs sound very strong. But should we be securing, $100 billion in them today? Like, how do you view this?
Well, I think like one of the things here is that, and just to be clear, like DLCs are not trustless. They require trust. They require trust in an oracle, and you need to trust that oracle is going to report on the right information. But you can know within a DLC that you are, because it comes down to the oracle problem at the end of the day, right? It's like, you need someone to report on real world events in order for something to happen in a blockchain, which is fine. But I think the key thing here with the oracle is that you codify ahead of time what those outcomes are going to be. So it's very easy for you to go and see, okay, well, at the end of this contract, what actually happened and what was that oracle supposed to attest to and what scenario was it supposed to attest to? And you can very easily verify exactly if they did that properly. So I think that's really the strongest piece here is that there's a very easy black and white verification process of did the oracle attest to the right thing? And it's very easy to add additional oracles that also have those same things. I heard an interesting thing about Bitcoin. Bitcoin is, what is Bitcoin? Bitcoin's just what is money? Money's just a religion. Bitcoin's just a religion, but it's one that's easy to verify. And, that's the same thing with DLCs, right? It just really is a system of codification that's easy to verify that all the parties are doing what they're supposed to be doing.
Makes sense. As much I don't want to get into word definitions, as you were talking, you mentioned it's not trustless because of the oracle, but we also have been using the word non-custodial. And maybe I'm just too grug-brained to know that like where there's tension there, but like help me understand.
I don't know what the right term is anymore. People say
Fair enough.
non-custodial. People say like, it's not custodial, right? It's not a custodial system. I would say the most, and it's like a question of lightning. What is lightning? Is lightning, you go and you enter funds into a 2 of 2? is that considered non-custodial or is it considered shared custodial? So I've seen both terms used. I think it's non-custodial in the sense that like nobody has custody of your assets and can unilaterally take them from you. But it is not completely self-custodial such that like you have full autonomy over your funds. Like you have decided to give up full autonomy of your funds in order to enter them into a contract that have very predefined outcomes. So I would say like somewhere between the term non-custodial and shared custodial with specific codified outcomes would be like the correct, politically correct term for DLCs. But
It's hard. It's hard
I
to market
agree with
that.
you.
Yeah.
I agree. Yeah, exactly.
I do think that there is a big differentiator once the Oracle is a third party, though. Because like if the Oracle, like Jacob, what you were saying, we're like if the Oracle is the lender, non-custodial, custodial, it's about the same thing because you need the lender to like let the funds go. But if the Oracle is a third party, like in our case, like we could disappear. We could shut down the platform, run, I don't know, someone assassinates all of us or whatever. And at the end of the day, as the borrower, you can repay the loan, take the attestation that the independent Oracle makes, sign the transaction, and get your Bitcoin out without the need for the lender or the platform to even be around. So I think from that perspective, I don't know the semantics, whether that's non-custodial, but it seems closer to non-custodial than like needing the cooperation of someone who's on the other side of a transaction.
Yep. Okay, that makes sense. Okay, I want to up level in a second to the capital markets, but as we're talking about oracles. I'm familiar with this thing called UTXO Oracle, which I think is you can get the rough price of Bitcoin via just the blockchain. Sounds pretty fucking cool. Why is this not safe to use as like something like DLC?
So yeah, actually UTXO Oracle is like really, really cool. Where basically they noticed that on average, when people send UTXOs, they send it with specific amounts that tend to correlate to like USD price, right? So if the current Bitcoin price is, 100,000 and people are sending on average like, $100 here, $500 there, people like to send things in round amounts, in dollar amounts. And so if you can build software that can basically, as long as you set an input price, it can then extrapolate what the Bitcoin price is just from the UTXO set, which is really, really cool. So like that's really great, and I think that's a really useful tool for validation of anything, right? So is at any one point, the price that's on Kraken or Binance or wherever, does it kind of line up with what people are actually doing in the Bitcoin blockchain? You can go and you can double check that. I think one of the big considerations with that though is that it only updates every 10 minutes. And so we even thought about this. Like, what if you could use UTX Oracle and you could use that as a price feed into a DLC to allow for something to happen? But I think you'd need like, you need CAT first of all on Bitcoin, and you need to somehow import all the UTXO set and then verify it against it would be a complete nightmare. It would be so expensive to run. It would be ridiculous. But the other thing too is it only updates every 10 minutes. So I think it's a really cool tool for like validation and double checking against certain things. But, at the end of the day for, Bitcoin backend, you need to be able to verify exactly what the Bitcoin price is based on the exchanges around the world. We have to protect, our lenders against a black swan event in case ever anything happens. So really, really cool technology, though. I love it.
Got it. Okay, cool. Then yeah, let's bring this back to, I want to talk about capital markets a little bit. Maybe you, Jay, because your previous background and whatnot. The idea of Bitcoin becoming pristine collateral everywhere, and we're seeing, the ETFs and all this going crazy. How do you see the capital markets thesis for Bitcoin, and how do you see this evolving and playing out?
Yeah. I mean, I think it's definitely interesting that, we're probably all too optimistic in the short term, but not optimistic enough in the long term. Like everyone's been saying like, oh, Bitcoin's pristine collateral today for the last like 5 years. And we're finally getting there. But I don't think everyone is actually bullish enough on the next 5 years or 10 years. Because I do think that like, beyond what we're doing, there's a bunch of folks in both the non-custodial and custodial space building very unique products on the idea that like over a long enough time horizon, Bitcoin is an asset that you can, trust is going to hold its value and appreciate over time. And so you can build a bunch of cool financial infrastructure around that. I don't know if you've heard of the folks at New Market, Battery Finance, they do a lot of these like, kind of like real estate loans where instead of putting in cash equity, you put in some Bitcoin and the lender and the borrower share in the price appreciation of the Bitcoin over time. And their thesis is basically, hey, an apartment building might go up X% a year in value, but the Bitcoin is going to surely go up more than cash would, right? Cash is, you're losing 2% or 3% a year, or, probably closer to 7%. So I think across the market, you're seeing a lot of this, interesting movement. I think for the lending space specifically, though, like the evolution has been kind of interesting where like, I'd say like CeFi 1.0, which was like, 22, 23, was basically, I'm a lender, I lend you dollars, I take your Bitcoin, and I take someone else's Bitcoin and a bunch of other people's Bitcoin, and I need to get dollars to actually make these loans. So I'll put it all in a pot and I'll go to someone who's bigger than me and put all of this Bitcoin as collateral and take out my own loan, right? That was effectively what like Genesis, BlockFi, Celsius were doing. At the end of that chain, you either need someone who's got real capital in the real world, or you have someone who's, getting the dollars by doing something like selling the Bitcoin or trading the Bitcoin, doing some delta neutral strategies, quote unquote. So I think that was kind of a shady world. I think we've evolved a little bit past that, where like now there's actually real lenders coming to the space who are basically like, hey, I'm a insurance company or a private credit fund, and I need to earn 7, 8, 9%. And it's actually pretty reasonable for me to lend against a pool of Bitcoin-backed loans, right? And so I think that's actually the big unlock in our eyes, why like the capital markets thesis for non-custodial works. I think it's twofold. One is that like, it's no longer the case that there's only a few people who understand what Bitcoin is. A lot of people understand it. And a lot of these more sophisticated lenders understand that, hey, I don't need you to gather all the Bitcoin and put it in a pot for me. If you tell me that you've made a bunch of 50 LTV loans, I will lend to you against those loans. And then, if one of those loans default, you need to liquidate it and send me back some of my cash. So I think, we can do that easily with DLCs because even though the collateral is locked on chain, we've pre-signed the spending paths for if there's a liquidation event. And I think, lenders are generally comfortable with that. The other kind of big unlock that I see longer term for us is, as much as we hate banks and we hate traditional finance, it's hard to think that a bunch of startups in Bitcoin are going to have the cheapest access to dollars. Dollars get printed all the time, and dollars get printed, the banks are closest to the money printer. And so, you can think about over time, like, why shouldn't the pool of people wanting to lend against Bitcoin expand? And if it does, and, we've been talking to a bunch of smaller regional and community banks, they're like, we'd love to lend against our clients' Bitcoin, but I don't want to touch the Bitcoin. I don't want to have to worry about custody and liquidation and all of this. And the nice part about DLCs is that actually abstracts a lot of it away from them. They can be a lender and say, hey, I'm making these loans, the collateral's on chain, and worst case, my liquidation path is to an OTC desk that's selling it for me. So over time on the capital markets side of things, I think we can, really bring in a lot more lenders with something like DLCs, because people who aren't comfortable with custodying, running operations teams, all of these things can effectively enter the market and make loans. And as borrowers, you get a great experience because you don't have to worry about, with DLCs, you don't have to worry about who your lender is. With CeFi, you kind of have to worry about like, do you want to take out a loan from FTX? Probably not. But like with something like DLCs, it's actually less of a risk.
I want to start to close this down. There's an interesting question here around, you mentioned the lenders, and there's an interest rate question here, like what do you get cheap dollars from? And I don't know who's running your Twitter. First of all, they're doing a good job. But in one of the replies, someone said something about the Oracle, and then the reply was, I'd rather take smart contract risk than Oracle risk. And then they politely said, you still have Oracle risk. No, duh. And it hit me that when you go into an L2, a sidechain, you take on so many trust assumptions, bridge risk, smart contract risk, that you don't even think about the Oracle risk. It's just implied. But with DLCs, you only have the one risk, so it's easy to call out. All that to say, as far as I know, DeFi has the cheapest liquidity typically. So like if you're on Aave and you're in Rat Bitcoin, you can get less than 5% dollars there. So how do you help me understand that nuance of like why is 10% the going rate for most CeFi stuff? Why is DeFi so cheap? Do you see that collapsing? Like, I'm not sure what question to ask here, but it's interesting. I don't understand that space.
Yeah, there is definitely, trust me, I've asked this a number of times, even at, when I was at Anchorage, we were like, $50 million loan to very large hedge fund, they get to borrow at 11%. But like me, I could open a Coinbase account, fund a wallet, and go to Aave and borrow at 5. Something seems off there. I think that's slowly closing. Like you do see DeFi rates, weirdly enough, as interest rates have gone up, the rate to borrow on DeFi has gone up a little. I think part of it has historically been that I'm no expert on what's going on in most of the DeFi world, but in DeFi, like you haven't really had access to risk-free yields. So like everyone, just assume like the Aave rate is the risk-free rate. So let me just throw all my extra USDC into Aave, which, as you've seen with some of this like whole Morpho situation recently, and I know Aave has a different model and maybe not as exposed, but like risk-free is not what you think is risk-free. But I do think that there's a lot of like trapped capital in DeFi that's basically like subsidizing these loans because they don't have access to better yield. As you see like tokenized treasuries and other yield products come on chain, I think that'll kind of subside. But the other thing for us is like, there is a bunch of interesting capital aggregation stuff that happens on DeFi that, we're not blind to. I don't think we're like puritanical in the sense that like, oh, like we only believe in DLCs and there's nothing else out there in the world. Like, we're talking to a lot of these DeFi platforms on, L2s on Bitcoin and, even in the rest of DeFi. For them, whether they're lending against CBBTC or a pool of Bitcoin-backed loans on L1 they're kind of indifferent. And so, I think we can work to a structure where it's like, if I'm the average user on Morpho or, name your vault protocol on Babylon or Stacks or wherever else, like, as long as I'm lending against someone who's got Bitcoin on the other side and I know if they default, it'll get liquidated, like that's great. And so for us, I think, we're going to work to connect those pipes because for us, the priority is basically get the borrowers the best experience possible. Borrowers shouldn't have to care where the lenders come from. And the lenders, assuming that it's trust minimized and locked on chain, are pretty comfortable with that. So I do think we can bridge, those two across. But yeah, totally hear you in the sense that like, it's kind of crazy that, I can go wrap some Bitcoin on Coinbase and borrow for cheaper than, even the biggest lenders against, the real hard asset. But I think that's only a temporary thing.
Okay, thank you for that. I guess last couple questions. Let's talk about what you guys are doing next. Like, what's the roadmap? Say 6 to 12 months out. This got you excited.
Yeah, I think the most immediate thing is really like as I mentioned, the integration. So, getting foundation device in there, getting more hardware wallets, getting more custodians, being able to integrate DLCs. And then after that, I think long term, it's, scaling out the Oracle tech, right? So how can we make it so that we can eventually go from single Oracle to multi-Oracle? How can we scale that up and reduce the trust that's needed in us even more? How can we make it so that people can verify exactly what's going on, with those DLC contracts? How can we get DLCs integrated into even more, not only hardware wallets and custodians, but even like software wallets, that you run on your computer, right? That's really where I think we want to see things go. Yeah, I don't know. Anything to add, Jay?
No. I mean, I think, yeah, the big things for us is basically expand the integration so we can get to more people where they're already comfortable. Like, I think we're kind of like, maybe we have the anti-fintech approach where it's like, we don't want to own your Bitcoin life. Like, you choose where you custody and we'll meet you there and make it possible for you to take out a loan. Like, we're not trying to be the Robinhood of Bitcoin or whatever. And then, the other piece is like, obviously on the product side, like we're always going to try to find better ways to connect more lenders so folks can get a lower rate, but like without taking excessive risk. And we can't, like at the very least, you can trust that when we give you a good rate, it's a good rate. We're not going and doing something with your collateral to get you a better rate. So, working on lowering the rates and then, flexible structures, we want to add things like longer term loans, beyond a year, maybe 2-year loans so that you can have, fixed rate financing for something that you need, something like amortizing loans versus interest only, like adding more flexible structures for people to choose how they want to borrow, I think is important for us. But yeah, I think those are really the two angles, basically flexibility on the loan side and then obviously choice on where you custody.
Love it. Okay, let's end on a nerdy note. Do you guys have any dog in the fight for any of the opcode upgrades, CTV, all that stuff?
I mean, I've been I've been hoping we were gonna get CTV years ago, but here we are in 2025. So I don't know. I would love to see I'd love us to just get something, for God's sake. Like we've been sitting around, we've been bike shedding. It'd be good to get some, even if it's not perfect, it'd be good to get something in. What was I looking at? See, it was CTV and CSFS, but I think there's actually an alternative to CTV that people are now in favor of. Let's ship it. I'm done. I'm done. How about you, Jay?
I think it would be nice if at least we started talking about covenants more than all the other garbage that's going on. Like, yeah, I'm with Matt. If we can get something, that'd be great. But if we can't get something, let's at least talk about something. But yeah,
Totally.
I'll remain permanently optimistic.
Wait, what about you, Jacob?
I'm with you. I want to flex that muscle again and show that we can actually do it. The worst case scenario is that we just bike shed forever and we ossify via just yapping on Twitter. Like that would be incredibly sad. And it's just crazy that the conversations are moving now. It's like it's from Twitter to like Telegram to it just we fight in different rooms. So yeah, even Cat is like I'm not a big fan of Cat. I think it does a lot of things clunky. And I'd rather have a cleaner thing for a software as important as Bitcoin, but like the attack surface is overblown, I think. So if that's what it is, I'll send that too. Like all the suggestions currently are not that bad because the immune response is so strong. So like, give me anything.
Yeah. Well, I would say one thing, if we're gonna get Cat, make sure CTV or whatever the alternative to CTV they're saying is, because otherwise it's going to be a nightmare for software developers to deal with cat scripts. I've looked at Midnail stuff, so we got to get that in. Yeah.
Yep. All right. This has been a great fantastic episode, guys. Thank you. Any closing thoughts as we bring this down?
Nothing particular, but I would emphasize, I think that a lot of people think that non-custodial or wherever on the spectrum closer to non-custodial we can get, people think that like it's like a trade-off curve where like the more non-custodial you get, the shittier the product gets. And I think we've proven, and we'll continue to prove that that's not the case, that you can build a great product for users while still giving them control. And I think you should always, question why you got into the space and why you're still here. Like I think a lot of people, like I said, come in for price and the returns, and everyone sticks around for the ideology. And so when you're building products for the long term, like what Matt was saying, it's kind of like a Lindy effect for products. Like we want to build something that can't fail because of us, that can't fail because of some human bad actor. And so I think for that reason, like non-custodial is going to stand the test of time, but also just aligns with the ideology of Bitcoin as well.
Actually, Matt, any closing thoughts?
Yeah, what Jay said. No, but I guess to add on, I don't know. I guess I'm just thinking back here. I've been thinking for a second here, and I've been building on Bitcoin for like 7 years now. I don't know. I'm just so fortunate. I feel so fortunate to still be building on Bitcoin, and I'm really excited because, I saw a tweet the other day. It was like, "Oh, DLCs are dead." No, they are not dead. They are alive and well. They are going to be used more than ever before, I think, and I'm so excited to be doing these integrations and getting more of this into people's hands because I think it's really cool tech, and I think Bitcoin is freedom. Bitcoin is freedom money. I feel so fortunate to be working on freedom tech. So I'll leave it at that.
Well said. Just to double click on the DLCs are dead thing, I posted a tweet recently that said, if you judge Lightning's future potential by its past adoption, you're both rational and retarded. And I think that's true. Like Lightning is incredibly bullish right now. Like Square just went live today for merchants in the US. A lot of good things going for Lightning, even with all of its headaches. Like Arc and Spark extend it in nice ways. If we get a Covenant opcode, we can do things. But it's also still a nascent protocol for the most part, just like DLCs are. So it's like better days ahead for sure.
Amen.
All right. That's the pod. Thanks, guys.
Thank you.
Thanks.
Where's this button?